Hi guys, welcome back to the YouTube channel. In this video, I'm going to tell you as a property specialist tax advisor, ways that you can potentially be paying less in tax by following the guidance that I'm going to give you in today's video. Hi guys, welcome back to the YouTube channel. I'm a property specialist tax advisor, and in this video, I'm going to share some secrets that are going to help you pay less in tax. So the first one is actually get some clarity over the strategy that you will be doing. So quite often we see this, I'm thinking about doing this strategy, this, and this. And ultimately, because they sort of do so many different strategies, it's hard to optimize for just the one or two strategies that they are actually going to do, because fundamentally, with property, you can't do everything at the end of the day. You need to have one or two strategies, one main one, one secondary one, and because ultimately where you put your attention on, you can't focus on all of these different strategies. You need to do one. Are you looking at new build properties? Are you looking at commercial conversions? Are you looking at HMOs, service accommodation, deal sourcing, rent to rent, whatever it might be? Because each of those is so vastly different for tax. So ultimately, you need to decide which couple of strategies are you doing. Usually it's a case of you've got one strategy for cash flow and one for wealth. So which of those are you going to do? And then ultimately we can help you get the right structure for that. For so many different businesses at the moment, a group structure is definitely the best way to go, especially for development, especially for rent to rent, deal packaging. Having that group structure is going to allow you to basically utilize the lumpy cash flow. If it's a development and you either sell the development or refinance, a group structure is great. Then if you're doing rent to service accommodation but want to get into BRR, well, that's fantastic, because you're going to use those profits from the rent to rent business. You want to move them across to the BRR business for deposits for the actual properties. And if you did that as in your own name, the tax consequences would be disastrous. If you did that with just two unconnected limited companies, you're going to have problems because you want to be loaning money across. So actually, in that case, a group structure is probably the best way to go. But of course, if you do just want to do BRR, nothing else, a group structure isn't going to be the best way to go, because you'll have multiple companies that you don't need. You will just need the one BRR company, just so that you can basically put the properties in there, get your mortgage interest, tax deductions, if you're a higher rate taxpayer and want to build it on, pass on, whatnot. But if you did just want 5 properties, BRR, that's fine. Your own name is probably the best way to go. So ultimately, it's about fully understanding what you want to do, where you want to get to, and then making sure you've got the best structure to take you there. Another fantastic tip is to make sure that you're paying yourself correctly. So quite often we see it where the business is maybe just started and people don't know how much they want to take out, and ultimately they miss the ship. They miss their chance to take the tax efficient money. So it could get to the end of the year and they say, I'd love to take a salary now. Unfortunately, the tax year's over. You've lost your personal allowance for the previous year. So definitely make sure that you know exactly what you want to take out of the business. You've got a forecast in place for your business. You know exactly what cash flow you have coming in, what you're going to take out to meet your lifestyle and living expenses. Because especially with property, with business owners, we see it more often, but property investors, they just get started and worry about the rest later. Obviously, as we know, we've got property specialist tax accountancy business, so we know firsthand just how some property investors, you're great to go in, build the money, do this, do that, but when it comes to actually the accounting and the finance side, that's often where there's some stuff lacking. So obviously, if you want to build that long-term wealth and pay the least amount of tax, you need to put some time, effort, and attention towards that. So making sure that you know exactly how much money you want to take out, and then ultimately putting the best way in place on how you're going to take this out. So quite often it's a salary, £12,570 for most people. But if you put money into your company as a director's loan, potentially look to charge interest on that, that's very tax efficient. You've got £1,000 tax free. Potentially another £5,000 tax-free as well if it's your first £5,000 worth of taxable income. Your savings nil rate band, that is, you've got your personal savings allowance, and even then interest income is fantastic because there's no national insurance, so you can potentially take out loads of interest income without paying a national insurance, and that's also tax deductible in the company. Then usually whatever you can't get out with salary and dividends tax efficiently, it's dividends on top. But you want to plan that out, so you know exactly how much you're taking. You don't want to get caught trying to take a dividend when you've not got profits, because that's an illegal dividend, which could mean it's either a director's loan or a salary. So ultimately, speaking to your accountant each and every year, putting a plan in place, and this is how much I want to take out. How can I do it tax efficiently? I've seen Josh on the internet say director's loan, salaried interest, dividends and whatnot. How does this work for me? Because ultimately that's what you need to be doing, is planning ahead so you can plan to save taxes. Another great way to reduce how much tax you pay is claim all of the possible expenses that you can. So we often see that people lose receipts, and this is kind of where having great financial systems come into place, because If you don't have any systems for accounting software, nothing to capture your receipts, of course this is going to happen. You're going to lose receipts. But ultimately, a lot of the time, if you lose a receipt, you lose a tax saving that goes with it. So make sure that you do have some good accounting software. Xero, you've got something to capture your receipts. HubDoc, Dext, or even you've got you've got a good filing system. You're putting them on your Dropbox. You're putting them on your Google Drive. You're taking pictures of everything, just so you can get it as and when your accountant needs it when you're doing your bookkeeping. So make sure you do keep good receipts for everything, and also just maximize what expenses you're claiming. So a lot of people really do underclaim expenses. A lot of accountants I see, especially when new clients come into us, oh Josh, I've seen you can do this. Why hasn't my accountant said this? Chances are they just don't know about it. Because a lot of these tax deductions, there's no single kind of accountancy school that you go and learn this stuff. It's just a case of learning as you get on, learning through experience, learning when working with businesses, and basically learning through HMRC guidance and the legislation. So you can claim your mileage, you can claim home office expenses. A lot of people don't know this, but if you work from home and you've got a dedicated area, you can potentially claim a proportion of your total household running costs as an expense in your business. If you think the way mortgage interest rates are going, rents are going, utility bills, that's a massive tax saving for basically claiming your home office for your business. Other ways, business travel. Can you put your trip through as a business expense? Are you actually going there on business? A lot of people don't realize this is, say for instance, you're going on a mastermind or to a networking event. Yeah, you might be going because you're kind of interested, but actually that is for the purpose of your business, so you can actually get a tax deduction on that. There's so many more that we run through. What else can you claim? You can claim your mobile phone, your laptops, all of this kind of stuff that you typically incur in your business, but you probably forget about. It might have some personal use. Chances are you can put that through your business. So make sure you're really checking and pushing with your accountant to maximize the expenses that you're putting through, because the more expenses you put through, the less tax you pay. Then the final tip I'm going to give you is basically stay on top of your VAT. So when it comes to VAT, so many different property and business strategies are actually exposed to VAT, and it's quite easy to overlook. The first point is when your turnover, so total turnover in a rolling 12-month period, hits the 85k mark, you should definitely be considering VAT. Of course, with property, normal residential property letting is exempt. But a great example of I see how people underclaim in VAT, because of course, VAT, it's all about what you fundamentally pay. But we've got people that come to us, they're property developers, and they don't realize they can actually reclaim VAT without having to pay it. So when it comes to kind of commercial conversions, residential property, you do have to charge VAT when you're selling a new build property, but it's just at 0%. So it's kind of technicality in the legislation where, because you're charging VAT at 0%, you can actually reclaim all of your input costs. So actually what ends up happening is when you're a property developer, you can reclaim a substantial proportion of your VAT from HMRC without actually having to pay any over when you sell the properties. So that's one of the rare cases where actually, but being on top of your VAT, and as soon as you get the development started, the earlier you register for VAT, the sooner it's going to help your cash flow, and you can start reclaiming expenses from HMRC in terms of the VAT, and ultimately have more cash in your business pocket rather than sitting with the revenue. But again, with serviced accommodation, with deal packaging, make sure that you're registering for VAT when you need to, and you're on the best scheme. Should you be on the flat rate? Should you be on TOM? Should you be on the standard? And there's so many different complications to it that you need to be proactively talking to your tax advisor, talking to your accountant about VAT, so that you aren't minimizing how much you're paying and ideally maximizing what you're reclaiming. So there we have it, guys. I hope that this video has been incredibly useful and is going to help you in your war against overpaying in taxes. If you found this video useful, please do give it a thumbs up as always and smash that subscribe button. That's all for now, guys. Bye.